Inflation is surging to the highest level since 2022. Just in, today's producer price index report just dropped a bombshell on the markets, coming in way higher than expected. Inflation at the wholesale level is surging like never before, with a jaw-dropping 0.9% monthly spike and a 3.3% annual jump, both far above expectations. From skyrocketing diesel prices to soaring retail margins, this report is screaming one thing: costs are climbing fast. Are tariffs to blame? What does that mean for consumer price inflation and the average American? Is the Fed about to slam on the brakes? So here is the producer price index on a month over month basis. So this is telling you the percentage change in producer prices since the previous month. We can see it came in way higher than expected at 0.9%, the highest reading going all the way back to the summer of 2022 when inflation was surging. Now, the expectation was 0.2%. This is a massive, massive upside surprise to this particular reading. Here is PPI and core PPI. Now, just as a reminder, there's three main ways that the government measures inflation. There's PPI. This is the cost for producers, producer price index. There's consumer price inflation. This is what you've likely heard of. This is what's mainly reported. And then there's PCE, personal consumption expenditures, which is yet a third way to measure inflation. There are three different kind of overall formulas or metrics that the government uses. Of course, PPI that we're looking at today, this is measuring producer price index. It is different and separate from consumer price inflation, which is what everyday Americans feel. We will show towards the end, we will get into the link and correlation or breaking of correlations in a second and how that difference gets absorbed. We'll do that in a second. But here's the annual rate of change for PPI. The expectation was 2.5%, came in significantly higher at 3.3%. And the expectation for core PPI was 3%, again, came in way higher than expected at 3.7%. So what's driving this reading? Here we can see disaggregated PPI. What we can see for the month of July, this monthly reading that we were looking at here, that 0.9%, the vast majority of it was driven by services, which you can see in this kind of orange sort of color. That is what is mainly driving this, just like the CPI report that we went over on Tuesday, which showed a similar thing. Very, very little kind of goods inflation and a huge amount of services inflation. And then we can also see that reflected here in the year-over-year PPI rate of change. Services are driving PPI. The vast majority of the inflation in PPI is coming from services. We do see that energy, which is in green, that has been in deflation for a while now. We are starting to see a slight uptick in energy prices, notably diesel prices, which we'll look at in a second. Here is producer price by all commodity. Now, again, very similar to the CPI, which had most of the inflation coming from services. That is what we're seeing in PPI. But it's important to point this out, which is this is the PPI index for all commodities. And what we can see, again, these month over month or year over year, they are tracking the rate of change of an underlying index. And we'll look at PPI final demand in a second. But this is the commodity, the raw commodity cost for these various goods. We can see it jumped significantly. It jumped about 50% here 2019 up to the peak, jumped about 50%. It declined, right? The Fed engaged in quantitative tightening. We saw disinflation and it declined about, 5, 6, 7%, but it had jumped 50%. So this goes to that kind of step change that I keep talking about that happened during 2020. Now, finally, here is that underlying PPI index. And again, we can see a step change function from where the trend rate was growing. And this has increased significantly. I mean, if we look here at 2010, so the past 15 years, producer price index has risen by 49%, really 50%. Now they're going to tell you that inflation is no big deal, but the cumulative cost of inflation is significant. Now, of course, not all of this gets transmitted, but it's important to point out. So here's PPI for services for intermediate demand. on a month over month change. Trade services, and when we go through these, I want you to look at the reading today versus the past 3, 4, 5 years. Trade services were up 1.3%, not too dissimilar from other readings that we've had. Transportation and warehousing services up 0.8%. Again, not that different from other readings we've had. Less trade, transport, and warehousing is up 0.6%. Again, actually lower than what we've been seeing for the past couple years. And overall, of course, this is up 0.8%. Now, intermediate demand, what that refers to is a good that is going to another business for further refinement. Further production is an intermediate good. Here is processed goods for intermediate demand, and goods other than food and energy are up 0.5%. We can see that energy is up about 2.2%. Now, remember, oil and natural gas are pretty volatile components. Food is actually down 0.1%, so showing a bit of deflation. And of course, overall, processed goods for intermediate demand is up 0.8% on a month over month basis. Here's PPI for unprocessed goods for intermediate demand. We can see goods other than food and energy up 2%. This is starting to get a little higher than we have seen readings before. Energy, again, minor contributor, only up 0.5%, although certain components of energy are up significantly, as we'll take a look in a sec. Food is up 2.9%. There's a really, really large increase in one of those items. And then overall, we see July for unprocessed goods for some other business to then further refine are up 1.8%. Moving on to PPI for final demand, this is what that headline is referring to. We can see services, less trade, transportation, and warehousing is up 0.7%. This is starting to kind of break out to a higher reading than we have seen over the past couple years. Transport and warehouse up 1%. Trade is up significantly, starting to break out 2%. Services is up majorly. This is again, services is mainly what's driving the PPI reading, as we saw from the prior chart. Services on a month over month basis is up 1.1%. Goods, less food and energy, this is starting to break out, 0.4% increase on a month over month basis. Energy is, again, minor contributor, up 0.9%. Food is up, again, much in line with other readings we've had for the past 5 years, up 1.4%. Goods overall are up about 0.7%, really no different and actually lower, arguably, than the past 5 years. And then finally, the total less food, energy, and trade services is up 0.6%. This is starting to break out. Here's PPI up top. Again, this is a year-over-year rate of change of this underlying index. It's an index. These measure the rate of change of that index. And I also overlaid CPI on a year-over-year basis and core CPI on a year-over-year basis in red and blue. And what I want to point out is that core inflation, here we're looking at just headline CPI, but CPI and core CPI do not necessarily translate with PPI. Yes, they are correlated directionally speaking, but we can see there have been many periods of time where PPI is running hotter than CPI is, right? And that's what everyday Americans feel is CPI. We can see here leading into '08, PPI, producer price index, was running at 9% year-over-year rate of change. However, CPI was only running at 4.9%. You can see here, again, during the heart of the GFC, both showed deflation. CPI was deflating. Costs were going down at 1.3%, but PPI, producer prices, were going down at 4.7%. So as you can see, there is a large delta between CPI and PPI. They are directionally correlated, but that does not always translate. It's not a one-to-one sort of thing. And if we look at core CPI, again, this removes food, energy, which are volatile. Once you look at core CPI, that story is even more pronounced. You can see there that PPI is like a volatile penny stock compared to core CPI. There's a huge amount of variation. Kind of the norm is to have a huge amount of variation between PPI and core CPI. And here, down here in green, I decided to do a spread where you take the PPI rate of change, so inflation rate for producers, and you subtract core inflation for consumers. And what you can see is that there is a wide margin. It is regularly a spread, either positive or negative, of 3 to even 4 or 5%. So again, just because PPI is surging does not always translate to CPI starting to actually increase. And again, that's what everyday Americans feel. Just as a reminder, this is core CPI. And again, the components of core CPI, services are in blue. Everyone in the mainstream kind of was expecting to see significant goods inflation from the tariffs. I was very public and said that that was unlikely to happen. We have not seen that. We can see that goods inflation is only contributing 20 basis points to the overall core CPI reading. So not even 10% of the core CPI reading is coming from goods. The vast majority is coming from services, just like we saw with PPI in a different color here in orange. The vast majority of PPI is coming from services. So it's really, really important to grasp the concept that this is not necessarily yet a huge spike in goods inflation. And even if it was, right, if you take that as a baseline, okay, this is goods inflation, even though the chart we showed that's not accurate. But say the majority was being driven by goods inflation. Well, then the question becomes how much gets passed to consumers? And as we can see, there is a significant delta between what ends up getting passed to consumers and what producers are paying. PPI also kind of goes in line with the business cycle and ISM and those sorts of things. So there's other contributors for the business and of course the labor market and all of those sorts of things. But as you can see, the difference between PPI and core CPI, it does not necessarily always get passed to consumers. And as we can see right now, there is a 0.8% delta between core CPI and PPI. You can even see where it is negative, where PPI is actually lower than CPI. But you can also see the reverse, which is here, for example, in 2023, April of 2023, PPI was 6.6% higher than core CPI. So again, it's not a one-to-one correlation. We also got initial jobless claims, and here are those readings. It came in 224,000, basically right in line with the estimate of 225,000. Now, let's go through the producer price report. They note in the second sentence, more than 3/4 of the broad-based advance in July can be traced to the index for final demand services, which rose 1.1%. Prices for final demand goods increased 0.7%. And what we can see here is a chart showing that. Final demand goods is in this kind of light blue. We can see that final demand services is really kind of what's running significantly hotter, both in the 12-month change and the 1-month change. So final demand, again, this is that headline number within PPI. There are kind of further subcategories, but the main one that gets reported, this is final demand, moved up 1.1% in July, the largest advance since rising 1.3% in March of 2022. Over half of the broad-based July increase is attributable to margins for final demand trade services, which jumped 2%. These indexes measure changes in the margin for wholesalers and retailers. Now, that you would expect with tariffs. You would expect to see those margins start to take a hit. 30% of the July rise in final demand services can be traced to margins for machinery and equipment wholesaling, which jumped 3.8%. The indexes for portfolio management, securities brokerage, dealing, investment advice, and related services, traveler accommodations, automobile retailing, partial, and truck transport of freight also advanced. Now, what's funny to me is that one of the largest drivers of that we just went through is, in fact, that portfolio management. Deposit management increased 8.8%. And if you look at business loans, those increased at 4.2%. If you look at kind of portfolio management overall, that was up 5.8%. So, we talk a lot about Dutch disease and how the American economy has become so hyper financialized as a result of the reserve currency status of the dollar and our massive trade deficits. Put another way, remember, a trade deficit means that we are running a capital and financial account surplus. This is why the smartest minds graduating MIT, they don't go to work for NASA, they don't go to work for the CIA. They go to work for Wall Street to design a algorithm for some hedge fund. Prices for final demand goods moved up 0.7%, the largest advance since rising in January, the same amount, 0.7%. 40% of the broad based increase in July can be attributed to the index for final demand foods. Now, there was a massive jump here in fresh and dry vegetables, which jumped 38.9%. The index for meat, diesel fuel, jet fuel, non ferrous scrap, and eggs also rose. However, energy decreased by 1.8%. Here's that intermediate demand, and again, this is a good that is going from one business to yet another for kind of further refinement into the final good. This rose by 0.8%. Unprocessed goods rose 1.8%. Both intermediate, right? So some intermediate goods are processed, some are unprocessed and going for further refinement. And prices for services advanced by 0.8%. Energy goods jumped 2.2%. That is what led the advance in intermediate demand. Over half of the July increase in prices for processed goods for intermediate demand is attributable to diesel fuel index, which jumped 11.8%. I'm sure that if this was not so high, we would have seen even more, this 2.2% processed energy goods might have been significantly lower if it were not just for diesel, which rose at 11.8%. Prices for industrial electric power, jet fuel, meats, aluminum mill shapes, and commercial electric power also moved higher. This is a kind of thesis of Luke Gromen that energy prices and Zero Hedge has also been talking about this recently, that we're likely to see significant increases in the cost of energy due to multiple factors, underinvestment for one in infrastructure, but also, of course, the surge in demand from data centers for AI. Conversely, the index for canned, cooked, smoked, or prepared poultry fell by 14%. Now going to unprocessed goods for intermediate demand, meaning unprocessed goods that are going to another company for further refinement. This rose 1.8% in July after advancing 2.6% in June. So this actually came down or is rising at a slower rate than we saw in June. However, 2/3 of that broad increase can be traced to prices for unprocessed foodstuff and feedstuffs, which jumped 2.9%. Unprocessed non-food materials, less energy, and unprocessed energy materials also moved higher, rising 2%, 0.5%, respectively. Over 30% of the July increase in prices for unprocessed goods for intermediate demand is attributable to the index for raw milk, which jumped 9.1%. So again, I will link this in the description so that interested folks can read it. And then finally, let's look at the yield curve and see where the bond market is going today. Here is probably a better way to look at it. We can see that the S&P 500 initially sold off, tried to bounce, and now is getting sold again. It'll be interesting to see how the market digests this particular report. Again, the vast majority of the PPI report was coming from services, and specifically things like portfolio management, deposit, financial services, kind of broadly speaking. However, we are starting to see significant increases in, say, margin costs or a hit to margins for retailers. Now, again, the question becomes, do they pass those on to the consumer who we know is tapped out? I think that if they try, you will just see demand destruction and therefore The vast majority will continue to be eaten by the producer, by the U.S. firm, and by the producer in whatever foreign country. I think that that continues because I think that consumers are just too tapped out. The ones I know, just anecdotally, are kind of in a deflationary mindset of I want to save money, I want to stop spending, and that sort of thing. So add an increase in prices. I think they say no, I'm done. I'm just not buying it. The yield curve is yields are rising to a significant degree across the curve. The 2 year is up. Opened the day at 3.67, is up to 3.74, almost 10 basis points. The 10 year opened at 4.23. It is up to 4.28. So about 6 basis point rise in the 10 year. And the 30 year is also rising, up from about 482 to 487. So up about 5 basis points. The dollar is trying to bounce again. I think that long term, medium to long term, the path for the dollar is likely lower because that's really what the administration needs to accomplish their goals that they keep talking about. Gold is down very marginally. So it'll be interesting to see how the S&P 500 closes today. But so far, it's about flat given the reading that we went over here, 0.9% month over month increase in producer price inflation. I looked at the odds of a September rate cut, and they are still pretty high. So the market seems to be looking past this, and maybe assuming that it is a one-time thing, assuming that the Fed is going to look through it and still cut rates, and therefore, risk assets will do well. But it'll be interesting to see how the market closes by the end of today. But anyways, hopefully that was helpful, and I will catch you in the next one.